The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25% and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%.
RBI Governor Shaktikanta has once again left interest rates unchanged at 6.5%, while also mentioning that food inflation is something the central bank will be watching closely. But can the central bank really do much about food inflation? Unfortunately, the answer to that is no. I'll tell you why not. First, let's try and look at the correlation between headline inflation and interest rates. Since the Russia-Ukraine war broke out in 2022 and global inflation went through the roof, central banks across the world, including the Reserve Bank of India, started the interest hike cycle. India stepped up the repo rate, or the rate at which banks borrow from the RBI, from 4% to about 6.5%, to 250 basis points hike in just 6 cycles. As a result, inflation was tamed from a high of nearing almost 8% to about 5.4% for FY24. RBI wants to hammer it down to 4%, but right now, inflation is not as much because of more demand in the system that RBI can control by getting people to put more money in banks to get higher interest. What is causing inflation to remain sticky is actually food inflation. The central bank honestly can't do much about it. Let me explain. If there's a bumper harvest season, then there is more supply for the same amount of demand. Sellers have to keep prices low to be able to sell their produce. But if the opposite happens, if there is lower farm output for the same amount of demand, sellers will be able to hike prices, leading to what we refer to as inflation. So food prices are basically dependent on not just total farm output, there's also the cost of transporting it and the damage incurred in logistics. So monsoons play the most important role in determining output quality. The RBI can't control it. Fuel prices determine the cost of transportation, again outside of the central bank's rate decision. And climate and warehousing play the role in wastage of food, again nothing that the monetary policy can do about. In the month of May, the cost of the veg thali went up by as much as 9% on account of a 40% increase in the prices of onion, tomato and potato from a year ago period. Add to that a 13% increase in the price of rice, and the veg thali now costs almost 28 rupees. But that could change for the better, and RBI won't really have a role to play. This year, the Indian Met Department has predicted above normal rainfall. This means that farmers should see better production volumes, so food inflation should naturally come down. Remember, RBI's job is meant to be preemptive, not reactive. The rate decision taken today will see an impact only a month or two later, so not cutting interest rates today, despite a good monsoon prediction, may be counterproductive. But obviously, the RBI governor and MPC members are more experienced than me to see these trend lines. So the real question is, why isn't the RBI cutting interest rates? One answer to that could be that RBI is waiting for the US Federal Reserve to first cut rates. See, interest rates and bond prices move in opposite directions. So if the RBI cuts interest rates while the US Fed doesn't, then Indian bond market becomes expensive and money flows to the United States. RBI doesn't want that to happen, so it is keeping what is called the spread intact. More money coming into India's bond market helps RBI and hence the government make more money. Now, arguably, that money can be deployed for infrastructure building, but it can also be used for funding freebies. There's a flip side to this. Cutting interest rates will not just make your loan EMIs lower, it will also reduce the borrowing cost for companies. If the cost of capital reduces, companies will be able to take larger loans and they will be able to defer their investments, or rather go ahead with their investments that they have been deferring in setting up, let's say, new offices and factories. So a lower inflation rate, I beg your pardon, a lower interest rate will help corporate India invest in job creation, which will in turn lead to more income and greater demand. Overall, a good trajectory for the economy. So is the RBI favoring inflow of money through bonds over private investment, which could lead to job creation? I leave you with that thought.